In my younger days, I shunned dividend-paying stocks. To me, they were what your father bought, what those who already had loads of money owned. In other words, these weren't the investments you bought to get rich. They were what you wanted after you became rich. That jibes with some of the biggest reasons why dividend payers appeal to a large swath of investors. As I've been fortunate enough to build some wealth over the years, I get the allure now. More importantly, these years have also taught me that it doesn't matter how your gains come. At the end of the day, cash is cash. Let me illustrate with an insultingly simple example. Say you have two stocks you purchased for $10 each as shown in the table below. Stock A climbs to $12 in a year for a gain of $2. Stock B ends the same period at $10 for no gain but paid out $2 in dividends over this span. Either way, your total return is the same at 20%. Of course, this makes perfect sense. Cash represents tangible value. So, when some of it is returned to shareholders via dividends, it should decrease the value of the company and its shares by the same amount. The flip side is that the stock of a company that doesn't pay dividends doesn't suffer from this recurring loss in real value, and will also accumulate cash more quickly as a result, which can then be reinvested to accelerate growth. That all suggests one must come at the expense of the other, and in practice this often seems to be the case. After all, generous dividend payers tend to operate in mature industries and markets that offer limited growth potential. In fact, it's not a stretch to say that some simply don't have anything better to do with their excess cash production than to give it back to their shareholders. Thus, while the expectation for capital appreciation is still there, the primary motivation for buying these stocks is for the steady and predictable stream of income they provide. Conversely, a smaller firm with more favorable growth prospects would probably be better off reinvesting its excess cash to generate stronger sales and earnings, which, in turn, should result in a higher stock price. Yet while rare, there are times when a stock can offer both. In my experience, these situations usually arise when a steady dividend payer that was already trading at a discount to the market suffers a sudden loss in share value on overblown operational concerns stemming from a softening in its near-term prospects or in the health of the general economy. Not only does this make a cheap stock even cheaper, but it also results in a more generous dividend yield as long as the payout holds steady. More importantly, it can result in a situation where a stock becomes significantly oversold and looks very compelling from a capital gains standpoint while also offering a dividend yield that has become high enough to appeal to income-seeking investors. But two other factors are usually required for such stocks to truly stand out.